Hello and welcome to Cathmere Capital Management's fourth quarter 2021 market and economic update. I'm Nick Ryder, the Chief Investment Officer here at Cathmere Capital. As usual, we'll take a brief look back at performance of global capital markets in the third quarter of 2021, as well as then turn our attention to a few of the hot topics that are certainly on the minds of investors everywhere. Looking first here at the performance of global markets in the third quarter, you see on U.S. and international developed market stocks, not a whole lot happening, basically treading water. Emerging markets being the main outlier, they're down a little bit more than 8%. Main driver there was China, of course, some negative or adverse developments emanating from policymakers there, as well as concerns about the health of the property sector, which is a big driver of growth there in China. Really drove emerging markets broadly lower. In the fixed income world, high yield and investment grade bonds, both taxable and municipal, more or less treading water. You see high yield up about 1% in the investment grade segment, all right around zero for the quarter. So not a whole lot happening there. On the year-to-date basis, you see U.S. stocks up nearly 16%, foreign developed market stocks up 9%, emerging slightly negative, really as a result of that 8% plus loss in the third quarter. High yield bonds chucking in almost 5% of gains, and then the investment grade fixed income world, it's slight losses on the taxable side, slight gains on the municipal side, but really not a whole lot happening there either. One thing worth highlighting when we think about the U.S. stock market, we do have some very strong underlying fundamentals playing a big role in the market's continued rise. So for the calendar year 2021, based on analysts' latest expectations, we're looking to see full year 2021 earnings up fully 36% relative to their 2019 levels. So, very healthy growth in a 2-year period that had a recession, of course, during the middle of it. This has been both, driven by a combination of strong top-line revenue growth. We see sales expected to be up 16% on the 2-year basis, and then, of course, margin expansion accounting for the other. So companies just becoming more profitable per dollar of sales, so driving that earnings number up more than 35%. So strong fundamentals playing a big role, which is always great to see. It's not just a valuation expansion story. Markets made 55 new all-time highs this year in 2021. A few things worth pointing out, right? If we have a strong fourth quarter, we could see ourselves potentially eclipsing that 62 number, which was realized in 2017, or going back to 1995 when we had, I think it was 77 all-time highs. Important also to point out here is that new all-time highs do have a habit of clustering, and you see a lot of these years with all-time highs numbers in the high 30s and into 40s. So certainly nothing out of the ordinary, but would be quite interesting to see if that number from 1995 could be eclipsed this year if we get a strong fourth quarter. Of course, this is something we've talked about in previous renditions of this webinar series. Right, a conversation I have with investors all the time, which is this natural state of unease that happens when markets are at all-time highs. And so the takeaway on this chart, not going to go through all the details of it, basically whether or not it's an all-time high today or not doesn't tell us a darn thing about what to expect going forward, as market rewards or market returns over the next 1, 2, 3, 5 years are the same effectively, whether or not you start on an all-time high or whether you start on any other day. So for us, not a whole lot of information, so to speak, contained in whether or not an all-time high, and it shouldn't tell you, shouldn't really drive or influence your investment decision making one way or another. Another topic that comes up a lot these days, and not surprising, really, is that people beginning to question once again kind of the merits or the value of international diversification with their equity holdings. Not surprising there if you look on the right-hand side. U.S. stocks have outperformed international stocks in 7 of the last 8 years, 9 of the last 11. Again, we don't have a crystal ball as to what the future is going to predict. We would encourage people not to necessarily drive looking in the rearview mirror. Right, we've seen this before. We've had stretches, namely through the late 90s into the mid to late 90s, where U.S. really had a strong run of outperformance. That, of course, was followed by an exceptional period of international outperformance. So, right, we always like to come back to that old adage. And it's, our compliance people make us put it there on the bottom. Past performance is not a guarantee of future results. We've seen this happen before where U.S. is led. We've seen periods where international is led, and we think the future will continue to see a mix of both. One thing that does, I think maybe slightly tilt the scales in the favor of international looking forward is some data that we'll show on this slide. So here we're going to look back over a 70-year stretch, or 50-year stretch, beginning in 1970. We see overall rolling 10-year horizons. So we'll call that long-term returns. Rolling 10-year periods, about 50% of the time you've seen U.S. stocks have outperformed, about 50% of the time international stocks have outperformed. On the bottom, though, we kind of cut all those rolling 10-year periods and kind of bucket them into two groups. The periods where we say U.S. stock returns were high, so to speak, and we'll call that 8% or more per year, and periods where U.S. stock returns were low or 8% per year or less. And what you see there is that when U.S. stock returns have been high or greater than 8%, U.S. has tended to outperform, right? 62% of the rolling 10-year periods, U.S. outperformed, 38 internationals outperform. When they're low, on the other hand, 75% of the time you see international outperform, with just U.S. outperforming only 25% of the time. We bring this up mainly because if you look at the long-range forecasts from the Vanguards, BlackRocks, JP Morgans, all the large institutional asset managers of the world, when they publish their long-term capital markets forecast, just given where valuations are today on U.S. equity markets, they're all predicting lower than average returns. Typically, the kind of central tendency is in that 4 to 8% per year range. If that were to play out, we think that certainly augurs in the favor of international to potentially deliver some outperformance looking forward. Value versus growth has been another topic. Again, we talk about periodically in these settings. Look over on the left-hand side, we see growth dramatically outperforming during the first 3 quarters of 2020, both during the initial downdraft of markets in the first quarter as well as the subsequent recovery. Pretty significant margins outperformance. Then fourth quarter of 2020, around the time of the election, also importantly around the time that we got news about the vaccines being demonstrated to be effective and right, this whole reopening theme played out. Some of the more beaten down cyclical oriented stocks really started to deliver some outperformance. Then of course Delta hit, the Delta variant that is in late first quarter, and we saw the last couple of quarters growth has regained the leadership mantle. We do think that value is poised for some outperformance looking forward. One of the reasons being what we show the data on this slide. This is a chart coming from asset manager GMO. And it's that we're seeing some what we think are classic signs of speculation within growth stocks. So here GMO is just looking at the percentage of growth stocks in the U.S. markets. So there's roughly 3,000 stocks for round number's sake in the U.S. markets. About half of those would be classified as growth, half classified as value. Nearly 2/3 of the growth stocks have negative earnings over the last 12 months. And so, right, we've seen this play out, and this is actually a trend that isn't just related to negative earnings from the coronavirus recession. It was, right, this was a trend that's been years in the making. What's been interesting is, right, all these unprofitable stocks in aggregate growth has been outperforming by significant margins. We've seen this before. 2009 was the last time you really started to see this sustained rise where growth stocks were very much in aggregate unprofitable. That, of course, is driven a lot, though, by some very significant negative earnings related to the global financial crisis. I think the more similar period to point out there highlighted early 2000s, right, the height of the dot-com bubble, where investors were really forward-looking, futuristic in their thinking, bidding up the prices of companies on the hopes that they would deliver positive earnings in the future. And so we think we're seeing a lot of that in today's environment. And that certainly grows concern about the sustainability of gross outperformance and why we continue to favor value, all else equal. Another topic that comes up in this kind of growth versus value is people will point out, well, yes, I get that, but let's look at really who are the main growth stocks today, right? It's extremely global, profitable, right, renowned companies. We look on the right-hand side of the page, largest companies in the world. You have Apple, Microsoft, Amazon, Alphabet, which is Google's parents, Facebook, right? All these are incredible enterprises that make a ton of money and that are growing pretty rapidly. What I caution here, and what we show on this chart, is the largest companies in the world by decade going back to 1980. And so you see all those companies, largest companies in the world today. The question is really, what is their ability to sustain this and remain the largest company in the world 10 years from now, right? Let's say. And if we look back, historically speaking, I would say the odds are certainly not in their favor, in that we've seen the top companies in the world are remarkably inconsistent from decade to decade. really, this is just suggesting it's really hard to remain on top, and there's a variety of reasons we could talk about why that's the case. But historically speaking, it's very hard to remain at the top, and we can see that just through time, going back to 1980, right? IBM, AT&T, General Electric, Eastman Kodak, they were really viewed as pioneers, leaders that would continue to dominate the industries they were in. 1990s, many of those companies nowhere to be found, with the exception of IBM, among the top 10. That is, all the Japanese stocks had taken over. 10 years later, the Japanese stocks had all fallen off. And so you've seen this pattern play out over time. While it's certainly possible that today's darlings will remain the largest companies in the world a decade from now, we would say history would suggest it's not, the betting odds are not in your favor. And again, to the extent that all of these stocks are much more growth on the growth side of the ledger versus value, one more tick in the favor of value, and we thinking some opportunity for outperformance in the years ahead. Turning now to the economy, a couple slides we're just going to touch on what I think is a key source of strength to both the economy at large as well as financial markets, which is the U.S. household sector. Here we're looking at the green line, what's titled personal consumption expenditures, just a fancy way of saying in the economic kind of data literature around, or data releases, that's personal spending or household spending. And you see took a big dip there during the first quarter of 2020 during the recession, but then has recovered nicely. It is now about 10% higher in August 2021 than it was in December 2019. Purple line is just going to be the opposite side of the ledger, the income side. So this is measuring all income going to households, wages and earned income, owners' income from businesses, dividends, interest received, capital gains realized, and then importantly, transfer payments from the government, right? So this could be stimulus payments, unemployment benefits, child tax care credits, which are now being distributed to households. And you see, one could be forgiven for looking at that line and saying, what recession, right? We had never did income necessarily really significantly dip below December 2019 levels. And you had those three big spikes, which of course coincided with all the stimulus payments going out to households. And so, income in August of this year, more than 10% higher than it was in December of 19. So household sector in a great shape from both an income and spending perspective. Here we look at, not going to go through the details on it, but households have dramatically reduced their debt burden from where it was in the height of the dot-com bubble. You've seen a constant, what we call deleveraging, so less debt relative to the aggregate size of the economy and the household sector today relative to where we were 10 plus years ago. That has been offset, of course, a little bit by what's happening in the business sector with the orange line, as well as, importantly, the federal government's fiscal positioning, which has deteriorated significantly over the last, call it 10, 15 years. But nevertheless, household sector, key source of resiliency. We'll save the discussion on the business sector leverage and the government debt for another day. What we take away here, right? We've seen household income up, their debt burden has gone down. The other side of it we haven't really talked about is the net worth. That's shown here. So the green shaded area shows household net worth. This is cumulative value of houses, financial assets, other assets, and you see all-time high there in the first quarter of 2021, which is I think the last data for which data was available. Second quarter of 2021. Cumulative about $130 trillion in net worth. And then the other side of it that's interesting to just look at is household debt service. And so debt service just means the amount of income households have that has to go towards paying down their debts. That could be mortgages, auto loans, credit card debt, student debt, right? Add it all up, divide it by income, and you see that that's about 8% of income now, which is quite a noticeable decline from where we were through most of the 90s and early 2000s when debt levels were higher, interest rates were higher. And so household sector, again, spending less and less of their money going to paying off their debts, which is a great thing. We'll kind of wrap things up with, I'd be remiss not to talk about inflation given the amount of press and topic of conversation that it is these days. Not going to go through all the details on this slide. The takeaway here is what we present is both the arguments for why people believe that inflation is likely to remain elevated for some period of time, and then for why people believe that inflation's recent surge is what we'll call quote-unquote transitory, which is what the economists and Wall Street people call it, which is transitory meaning just temporary or very short-lived. And so there's a lot of strong, compelling arguments, I think, on both sides for why inflation is, could be more sinister and remain sustained and elevated. I think there's a lot of compelling reasons why inflation may ultimately prove to be transitory. I think if I had to give a balance to it, I think investors need to be cognizant and mindful of the risk that inflation remains sustained or higher than what we've come accustomed to. I don't think we're returning to 1970s levels of inflation, but I do think it's quite possible that we do see 4, 5, 6% inflation for some period of time, and that things might not fall back down to the Fed's preferred kind of 2% inflation level as quickly as I think policymakers are expecting. If you want to go through the details of this, and importantly, what it means for portfolio positioning and how we're implementing that in portfolios, or that taking into account that risk, reach out to your advisor. We'd be happy to send you this slide as well as a few others, and have a conversation about how we're reacting to inflation in the portfolios. One thing I do want to share is one component, I think, just why from a calculation perspective, or when we think about the aggregate inflation readings, why I do think inflation could remain higher, and it simply comes down to the housing component of inflation. So, and what's happening is that we have yet to see housing really be a significant contributor to the official inflation readings. What we show on the left-hand side, housing components are roughly about a third of the weight in CPI, which is inflation core consumer price index. That's the official reading of it. About a third of the weight in those calculations comes from housing. Portion of that, the lime green, 7.5%, is rent. Those are measured. The other part is most people own homes, or a majority of people own homes, and spending goes towards homes. That's an estimated number based on surveys, which is around essentially asking people what would they be willing to rent their house out for if they didn't live there. Importantly, you see that third component, a third of the inflation reading comes from inflation. Importantly, on the right-hand side, we're looking at year-over-year changes. So inflation has been about 5.5% over the last year. Importantly, you see those two green lines, both the rent measure and the owner's equivalent rent, both hovering in the 2 to 3% rise. So dramatically lagging the overall headline rise rate. A lot of that headline rise has come from the pop in energy and commodity prices, food prices, as well as in some other goods and services that have gained a lot of press. Used and new cars have seen their prices surges, hotel rooms, airfares, A lot of these kind of cyclical pops from coming out of the COVID-induced price declines. Those have been big drivers of it. Importantly, inflation on the housing components has started to turn higher, but still lagging dramatically behind. Both of them running in the 2 to 3%. Keep that in mind, as you compare the stark contrast with what we've read and seen going on with housing around the country, which on the left-hand side we see house prices are up roughly 20% year over year across the nation. Certainly pockets of the country have seen more significant rise. Pockets have seen less, but in average, house prices are up about 20% year over year. Rents on the chart on the right-hand side, we've seen apartment rents are up nearly 10% year over year. Single-family home rentals up more than 10% a year. So, see both of these numbers up more than 10% year over year. Yet the official inflation reading is only showing 2 to 3% rises. We think there will be some time in the coming months and quarters where those numbers will catch up. Even if they don't get to 10% year over year, even if they just rise into the mid-single digits, 4, 5, 6, that will certainly, even if you have a subsiding in some of these areas like used new cars, et cetera, if they turn over and inflation doesn't sustain there, that just the housing component, you can reasonably pretty easily see a scenario where inflation remains 4, 5, 6% for months or quarters ahead, and so maybe not falling down to 2% as quickly as policymakers think. Wrap things up quickly with an executive summary. We talked about equity market remains intact. You've had strong economic growth, supportive monetary policy, and importantly, strong corporate operating performance and strong fundamentals underlying it, with earnings up nearly 35% in 2020 versus 2019. We again recovered. We're at all-time highs or near within shouting distance all-time highs. Investors don't need to fear those in and of themselves. They don't really tell you much of anything about what to expect in the future. International stocks have trailed in recent years. Importantly, though, we've seen cycles of international outperformance. We've seen cycles of U.S. outperformance. And importantly, during periods of quote-unquote low or below average U.S. market performance, international outperformed. I think that's kind of our base case looking forward over the next 5 to 10 years. we think investors will be grateful they had international exposure in the decade ahead. Growth stocks have resumed their leadership over the last few quarters, but we think they are vulnerable to some reversals for a number of the reasons we talked about earlier. Household sector remains a key source of strength in the economy, right? We've seen net worth at all-time highs, income at all-time highs, spending has recovered sharply, debt service remains low. Key source of resiliency and strength, so providing support to the economy at large as well as financial assets. And then inflation, you've had this surge lately. We think it's likely to remain elevated, not necessarily heading to the double-digit levels of the 1970s or into the early 80s, but we think probably going to remain above the 2% or so level that we've become accustomed to. Keep in mind, we have positioned portfolios accordingly. We certainly take into account the risks from inflation, and those have played their way on how we think about portfolio construction today. So with that, I thank you for taking the time to listen, and please do stay on the line to browse some of the important disclosures.